Hey everyone, me Kevin here, coming to you with another full self-driving video on something weird going on in the marketplace. Now this is going to be mostly anecdotal, though I'm going to tie some of this in with data. As you know, I've been traveling the entire country studying the real estate market. I am not just sitting looking at charts, I am looking at charts and out on the ground in person, talking to realtors, to buyers. I meet course members and other buyers out on the street who are like, oh, I'm buying, here's my situation, what do you think of this house? It's kind of crazy. Every time I go travel somewhere, so I was like, it's me, Kevin, and then we talk about their situation. I love seeing y'all out there. But what's weird is there is a big disparity in who's buying today and how they are buying. So let me clarify this. First of all, when I say how they are buying, I am regularly, and this is insane to me, I am regularly coming across other buyers who are all cash buyers, but they're not. The listing agents are telling me when we're writing offers as House Hack, because we are, when we're writing offers, they're like, oh my God, thank you for actually having cash in the bank and not being another BS, and they'll actually say it like they're pissed, another BS cash offer. Because what's happening is people are coming in, they're writing offers on fixer-uppers, and there's always competition. I wanna be very clear about that, okay? We've gotten, in like the 3 weeks we've been trying, we've gotten 3 smoking hot deals already, and we're like half trying, okay? Like we're not even like all in on trying yet, and it's going very well already. The 3 deals we've already got are probably each over $120,000 wedges, so they're going really good. The problem that we face, well, it's not really the problem housing faces, the problem the economy faces, is it seems like there are people who are going out of their way to do hard money financing. And they're saying they're cash offers, but they're still contingent upon a hard money finance deal. And these people are speculating. Now, fortunately, we're still getting deals because a lot of the agents are like, I don't trust this crap. But some of the deals that we've lost, we're losing to hard money deals, and we see them fall out again and they come back to us. For example, the last one we got, I held firm at my numbers. I'm like, watch guys, they'll end up coming back, that other deal's gonna fall through and they'll come to us. And that's exactly what they did. But there are many more that are closing to people who are purely flip speculating. And let me give you some of the terms. You ready for this? 3 points. So you spend $600,000 with renovations. At 3 points, you're paying almost $20,000 in loan fees just to get a hard money loan. And now you're paying 14% interest. That's what some of the terms are that I'm seeing. And now, and they'll finance everything for you. But at 14%, you're paying $84,000 a year, interest only, just to hold that property. Works out to about $3,600 a month. Once you add in property taxes and insurance, you're probably about $4,500 a month. Add to that, renovations and all this stuff. You've got a big leak. And if you can't profitably sell that property, especially going into now the winter months, where I think prices will probably be slightly up to flat, and this is really the opportunity to buy, you're betting that the spring market will be hotter. Now, I don't care because we're buying long-term buy and holds, but some of the people speculating right now, I'm like, this is crazy. I think some people out there are thinking it's gonna be 2021 all over again when rates come down, and I don't think so. I think we're much more likely to be back to a 2012 or even a 2011. Where in 2011, we're kind of like, okay, prices bottomed the year before in 2010, and now they're kind of up, and now they're a little down. You're pretty volatile in 2011 as inventory was up, but more buyers were coming out, right? And that's something that could happen here, is you could see rates fall, which lead more buyers coming out, but also more inventory coming out. So you get almost this vacillation, this volatility. But it's not just that speculation that I see, which almost in some cases reeks of desperation. It's almost like some of these flippers are like, I made so much money in 2020, 2021, 2022. Now I just need to get any deal. Just give me any deal. And even if I make 20 grand, please, it'll let me survive a few months longer. That's what it feels like. So again, it's great for House Hack because we're only gonna do deals where the numbers make sense. And then otherwise I'm just not gonna buy properties when they don't make sense. We buy within our wedge and we have no problem getting deals. But this is an example of what I'm seeing in certain areas. And what's interesting is the speculators are not everywhere. For example, they are not in Oregon. In Oregon, I don't know what it is with that market. And if you look at the actual data, you'll see more price drops, weaker price growth, and more supply. Compare Oregon to San Diego, okay? That's where apparently all the speculators are. Or even like Fremont, California, which I don't really want to buy it there anyway. But the rents are just too low. But you have people who are even home buyers doing this kind of speculating on these hard money loans, and it's just insane. So I'm worried that this is a little bit of a sign that people are kind of on their last legs as competing buyers. That's an opportunity for people with capital to deploy, obviously, like House Hack, but it is a risk that I highly recommend people do not engage in. I highly recommend do not speculate with hard money loans to where you're overpaying for deals trying to make 20K. That's stupid. You honestly should not be touching a deal unless you're making 100 grand per 500K invested. That's my POV. Whatever. So anyway, and that's how, obviously I hope to IPO House Hack at some point in the future, is by taking properties people can't live in and turn those into functional, on the market, supplied properties. But anyway, that's something I'm noticing throughout the country, is this speculation has sort of ramped up. But the speculation is only in the roughly certainly under the $1.2 million mark, but only 1.2 million once you start getting into NorCal. Most markets, that speculation stops at about 800K. And there's plenty of speculation in the $400,000 to $600,000 range, because the monthly payments just aren't that bad, even with a hard money loan in those price ranges. So for example, I just went through a multifamily building that was actually 4 single families, and it's $2.8 million, and it's just sitting. And I'm like, well, it's kind of no surprise it's just sitting, because the type of buyer who would buy this isn't here. So that makes me much, certainly, like, I'm like, it's not gonna work for me either. I'm not gonna overpay for this. But I find it very interesting, because even though we're getting plenty of deals, there is this weird stretch going on. And to some extent, you see that happen in every market. Certainly in 2021, people were doing this as well, where they're speculating, oh, prices are gonna skyrocket, and that worked out well. But if you combine that with the speculation you've seen in Airbnb, I think some real estate investors are probably going to be hit in the face with reality over the next year. And I don't think that's because prices are going to plummet. There are plenty of home buyers who are going to absorb this remodeled supply, but remodeled supply that has to sell. You want to know a market where that's exactly happening, in my opinion? Look at Palm Desert. It's a super high Airbnb market. You got to be really careful about these markets. This is all the kind, look, in like 10 minutes here, I'm trying to give you a synthesis of what I'm seeing on the ground and with the data, with real experience as an actual investor, not as a chartist who's only telling you, oh, homeowner affordability is really bad. No, duh. Have you looked at interest rates? No, duh, homeowner affordability is really bad. Yes, rents have gone up, but not as much to make buying make sense at these rates. But people are speculating rates are going to come down. So if they do, they'll be right, and those charts won't matter. But what is a real problem is the potential Airbnb bust. You look at Palm Desert, remodeled home after remodeled home on the market. In fact, there is one home on the market for every about 150 people who live in the Palm Desert. Compare that to San Diego or like Chula Vista, where there is one home on the market for every 3,000 people. That means you have roughly 30 times as many homes per capita in Palm Desert on the market as you do in Chula Vista. Gee, why is that? Well, Palm Desert is a vacation destination for Indian Wells, the tennis competition, Coachella. It's an Airbnb market. That shit's danger. Stay away, okay? Like, I would not touch that with a 10-foot pole right now. And that's why they say all real estate is local. You can't just, draw like, take a big fat paintbrush and go, everything sucks or everything's great. You gotta be really careful. Then you look at like in Oregon, where it's just like, okay, well, why is that so weak? It's not an Airbnb market. It's like people aren't speculating there, or people aren't even wanting to invest there because maybe the long-term rentals and vacancy rates are worse. That's another thing you have to consider. When you buy real estate, would you rather buy real estate in an area where the vacancy rate is 2% or where the vacancy rate is 10%. Colorado has a vastly different vacancy rate than South Florida, okay, or San Diego, for example. You look at a mid-market, you've got somewhere around 500 to 1,000 homes on the market. That's like your Utahs, other parts of Cali, whatever. You've got about, one home on the market per 500 people. That's like more normal, maybe one home per 1,000 people, more normal. Chula's one extreme, and then on the other extreme, you got Palm Desert. So the point of this is to say, I don't think that we are set up for this broad-based, massive, disastrous crash in the real estate market. But I do think certain areas are going to have a lot harder of a recovery. And if you are investing, you want to make sure you're investing and getting good deals, not in markets that are tanking, right? Because then you're not really getting a good deal. So you want to be getting good deals in hot markets. Ideally, certainly there's this balance of like, oh, is it a bubbly market? But fundamentals will tell you that. Fundamentals will tell you, do people want to live here? What are the jobs? Why are people moving here? What are the median incomes? What are the poverty rates? Remember, people always say like, oh, but this area is up and coming. Does a person with a 700 plus credit score want to rent in an up and coming area? No, they want to rent in a nice area. And then you have a tenant that pays the bills and takes care of the property, right? You buy properties in up and coming areas or dying towns because the cash flow is slightly better. You're just signing up for a higher vacancy factor, a higher eviction factor, a higher repair and damages factor, and you're just making your life more miserable. So, point is, you've got to, maybe just watch this video back, or, sign up for the courses on Building Your Wealth, link down below. We got an expiring coupon going later today. You already know the drill. Email us at staff@meetkevin.com if you want to bundle up. 0 to millionaire, real estate, stocks, psychology, money, everything. I want to give you the straight scoop. Look, what gets the most views on YouTube right now is everything's going to hell. It's the worst real estate recession is coming, and you're finally going to have the great reset opportunity to buy a cheap home. I'm going to give you the reality. Some of these markets are legitimately and fundamentally doing substantially better than others. That's just the way it is. That's the reality. And other markets are going to suffer. So it is not one size fits all. Anyway, thanks so much for watching. I'll keep you updated. Appreciate you. And we'll see you soon. Thanks so much. Check out the courses below. Thank you so much. And we might do on a house hack update. It's supposed to be the fundraisers this September, 2023 September. And we are probably going to offer the shares to course members only, since it's going to be at that 1-to-1 valuation. So you're better off using the expiring coupon code to get in, so you make sure you have access, because once we're out of shares that we have allocated with what the SEC allows you to sell in this Reg A, there's a limit, that's it. And it's gonna be course members first. So anyway, thanks so much. We'll see you soon. Bye.